Nasdaq results out this morning. We are in the house of Nasdaq. Earnings of $1.27 per share, coming in 6 cents above estimates. Revenue also above Wall Street forecasts. And joining us right now is the owner of the house, Adena Friedman, Nasdaq president and CEO. Good morning.
Good morning. It's great to be here.
What seemed like a crazy quarter actually turned out to be a good one for you. Why?
Actually, all of our businesses performed well. So we had 6% overall organic growth and 8% growth in the non-trading businesses. And we do tend to focus on those because those are where we have a lot of demand coming in from international exchanges.
The non-trading businesses.
That's right. Our broker-dealers who are buying technology from us, as well as our data analytics business. And then the IPO environment has remained healthy throughout the year. So we are benefiting from that also in the quarter. So every business contributed to our growth this quarter.
I imagine you want investors to start, I mean, not to start, you probably want them to do this many years ago, but to really look at your company away from the trading business. We
have been really focused on Nasdaq as a technology company serving the global capital markets. And the growth of our market technology business continues to demonstrate that. So we had 9% organic growth and 27% overall growth in our market tech business. And we had 11% growth in our information services business, driven by index and our analytics business. Okay, so we're really, really proud and pleased with that.
Do two things for us. Project out to the extent you can what you think the next quarter or two looks like, both in terms of how, and because this goes to both CapEx, how companies are thinking and how healthy they are in terms of spending on products that you're selling, and then the other side of it, which is to the extent you believe that markets and trading and IPOs also are all interconnected to this.
Sure. Well, on the market technology side of the broker-dealer community, there are a lot of trends that are really driving demand for our technology. And one of them actually is striving for efficiency, because we can offer market technology third-party services that are cheaper than them being able to build them internally. And then they also get the benefit of better performance in their trading systems so that they can actually compete more effectively. So they're looking for efficiency, alpha, and more regulatory services that help them avoid fines. Our surveillance business is a healthy grower because of that third component. And then our market technology business really helps exchanges and broker-dealers be more efficient and drive better performance into their systems. So we're pretty pleased with the fact that even in a trend where they're cost-conscious, they're still a buyer.
You know, yesterday I was walking down the stairway here, and they were busy putting up new photos because you guys have had so many IPOs that have come through just in the last couple of quarters. They've got to get new things up on the wall. I think you've had a win rate of about 77% of the new IPOs that are out there. But with some of the weakness we've seen in that IPO market, do you think the window has closed? Is it closing? What's the sense you get? Because that's kind of the sense we've gotten.
Well, first, to answer Andrew's second question on the market performance, I would say the overall volatility in the market has been helpful to us from a trading perspective. And then the IPO environment, you're right, Becky, that we have had a 76% win rate so far this year, about 147 IPOs through the third quarter. And when we looked at the rest of the year and into 2020, we actually have not been anticipating that the fourth quarter was going to have as many IPOs as we've had in the second and the third quarter. And that will likely be the case, but that has been something we've expected for several months now. I would say going into 2020, though, we do see a really healthy pipeline of companies wanting to come out. So the performance of a few names and looking at, I think everyone assumes that they're an individual story and that they will look at how their story resonates with the public investors. And they're preparing for that. So our conversations continue to be very enthusiastic.
What do you make of this WeWork situation?
So I think that we have to recognize that when a company chooses to go into the public market, there's a lot of disclosure that occurs. And those disclosures are there for a very good reason, which is as companies are coming in and tapping retail investors, everyday savers who are trying to put their money to work, they have to disclose a lot of things about the, internal workings of the company. And those disclosures, I think in this particular case, worked in terms of making it so that investors could make an informed decision.
Do you think there's something, though, broken in the private markets right now around valuation?
I think that they just are different priorities. In the private markets, investors are really, really focused on hyper growth. They'll look at anything that has a really big total market opportunity and your ability to attract that market opportunity into your business. And they're really focused on growth. Public investors are looking for profitable growth. And so they really are more focused on how do you drive that growth into profitability and how do you then generate profitable growth. Those are two different things. They're two different priorities. So as I think private investors, as they're thinking about starting to move their companies towards the public markets, they also should think about how do they help the companies drive towards that view of profitable growth.
But how do you think everybody got this one so wrong? And the reason I ask is because there's a lot of real people who've been injured by this. Employees who were lured to this company under the assumption that this company was going to go public at even if you didn't believe $47 billion, if you thought $40 billion or $35 billion, at a time, by the way, when some of the companies who underwrite these IPOs on your exchanges, the Goldman Sachs of the world, the Morgan Stanleys, are saying this thing, and they're telling Adam Neumann, and this is not a defense of Adam Neumann, but they're telling him, we think we might be able to get $80 billion for you. We might be able to give it $100 billion for you. So how do you look at that? And by the way, you are also in the private markets. You're not just a public-facing
right. We do support companies who do secondary transactions in the private markets.
Right. So people like Adam were actually able to get out of some of his own stock through private markets.
So we're not going to talk about, I'm not going to talk about any specific company, but I would look at it and say, okay, let's look at it from a process perspective. I think that there are certain disclosures that occur in the private markets among a relatively professional investor audience. And it is up to the professional investors to make sure that they're digging into what they need to know in order to make an informed decision. But it's up to them because there's no disclosure regime in the private markets. In the public market, there's a very robust...
Do you think there should be, though, in a time when so many public investors through BlackRock, T. Rowe Price, Fidelity, and others are now buying into private companies through private markets?
So as you go to the public markets, you have a very, very specific public disclosure regime. I think that if you want to look at the professional investors, the big funds, the big VC firms, they have the ability to go in and probe as much as they can. And if they're not comfortable with the ability for them to probe into the company, then they can make a choice not to make an investment. But that's why those types of companies are put into the hands of professional investors who may be acting on behalf of retail, but they are professional investors who can do their own work. And that's a huge distinction that the SEC has made for a long time, which is if you're a high net worth investor or you're a qualified purchaser, which is a very, an institution, you have the ability to do a lot more to get information that you need, but it's kind of up to you. The minute it goes into the public markets, that's when the SEC says, but not every retail investor individually can go in and find that information out themselves. So that's when the disclosures come in. And to me, that is the difference between the private market and the public market, and it comes with different risks.
Final question for me. Jay Clayton, who runs the SEC, made a comment back at our Delivering Alpha conference about this idea that oftentimes, or too often these days, IPOs are really just a liquidity event for a company as opposed to part of a longer journey. And how do you get private companies that have been private for so long to start thinking we need to get public earlier so that actually the public investor can participate in some of the growth?
Yeah, we've definitely been advocating for a long time that we really would like to see companies tapping the public market sooner. And what we've discussed with Jay Clayton, Chairman Clayton, is what's the regulatory regime that exists that keeps companies from wanting to go public earlier? And part of that is the
shareholders.
It's actually it's definitely the view that actually there's certain elements of the system that make it much harder to be a public company. And I would argue that some elements of the proxy process are really not designed to be favorable towards public companies.
Look, I'd say it's just
and then there are
liquidity
other elements as well.
There's so much liquidity out there. If I don't have to go to the public markets, it's a lot more regulatory oversight. It's a lot more headaches. It's a lot more bureaucratic red tape to jump through.
Yeah, and we've always said that you've got this really ready capital available in the private markets against a public system that does require a lot of discipline.
For good reason.
We're happy to have that discipline so long as the discipline is really designed to allow investors to make an informed decision. Right. There are other disciplines in the public markets that make it harder to go and just operate your company. So we want to try to get rid of those but maintain that disclosure regime, which we're really proud of.
What about TD Ameritrade, Schwab? It's all free. It's all free. Any plans to match this and do everything free at the Nasdaq, get ahead of the Warren Sanders presidency, or go non-profit at Nasdaq, or no plans for that right now?
We're very pleased to be able to provide value to our shareholders and our clients.
And charge for it.
We also, it was interesting to watch that because it happened so quickly.
Weird.
And everyone assumes that it happened quickly, like it was a snap decision. I believe that the firms have been understanding the impact of that and planning for that for a long time. And they knew as soon as the first one just made that decision, they were all going to have to follow.
Pretty amazing to hear.
But they had been diversifying their businesses for several
really?
years.
Well, they still had to say we're trying to figure out how to replace $250 million in lost revenue.
Well, so it's really interesting because I think some of the firms were very prepared. They had built out stock lending businesses. They have asset management businesses, ETF businesses, other things that really diversify their revenue stream so that they could be prepared for this, because they've been watching Robinhood and others, other free venues come up and rise up. So I think that they saw it as something that they knew they ultimately were going to have to try. I also would say that for us, we provide a service that is unbelievably efficient and effective in terms of the trading business. The trading business is incredibly affordable, and it's a tiny fraction of what they were charging to their own.
We're going to keep running commercials too.
Okay.
Decided, right?
Thank you.
All of us.
Thank
Appreciate
you.
it.